But risk on, the more dynamic, risk-taking, growth-focused, how am I going to drive my business and generate returns, isn't quite there yet. We're at that turning point. And I think that what we're really waiting for is for this more risk-on to kick in, for shareholders to be demanding that corporates are really showing strong returns. That will encourage those businesses to get out and start investing and doing things. They're going to find that very difficult in Europe. They're going to find it very challenging in North America. We expect that to feed through over time into really quite a strong resurgence of activity here in Asia Pacific. From an investment point of view, that clearly feeds through into the investment climate that we're in. The very positive movements, in fact, the quite strong bounce back in capital values that we saw through 2010 through 2011 very much slowed and in Europe turned slightly negative, but in most of the rest of the world it kind of slowed to more stabilisation during 2012. That's partly because we have seen that rental growth moderating, so we haven't had rents giving a positive impetus to capital values, and it's also because, to be honest, in many markets, yields have pretty much reached the limit of their compression. The strong demand for the very defensive, good quality real estate that we saw had pushed prime yields down right the way around the world in the major markets. Interest rates can't go any lower in most of the rest of the world. We are reaching some kind of floor. Despite the fact that pricing across much of Asia looks pretty aggressive, particularly at that better quality end of the market, we have seen capital values, therefore, just moderating slightly, still moving upwards, but investment volumes have continued to rise. This, I have to confess, is something of a surprise. We were expecting the hesitancy and the price increases to start to limit activity. A lot of it is not the top quality, top end prime product. A lot of it is local markets, strata title sales in Hong Kong. But there's no question that the momentum and the demand for real estate has remained really quite strong. I just want to spend a couple of minutes looking at the cross-border flows and cross-border elements. Obviously, there's a lot going on in the individual markets across Asia Pacific. But if you look at the flows of capital around the world, in terms of Asia Pacific, we can split money moving cross-border into two groups. Asia Pacific-based investors moving money around the region into different countries, and money coming into the region from outside. And what you can see is that the GFC marks a real watershed. Everybody was, from a net point of view, this is net investment, so netting off what you're buying cross-border against what you're selling in other countries. And you can see that since the GFC, non-Asia Pac investors, global money, if you call it like that, has been consistently selling in Asia Pacific more than it's been buying. Whereas Asian money has increasingly been moving around the region and buying more cross-border. The exception, the final quarter of last year, where finally we saw that global money turn positive. But if we split out the Asia movements from the Pacific movements for this global capital, you can see that actually there's a clear distinction between what's been happening here and what's been happening in Asia. In Asia, it's moderating, but it's still negative. They're still selling more in Asia than they're buying. In the Pacific, we've seen a gradual recovery and notably a sharp uptick in the last 2 or 3 quarters in the amount of money coming into the market from other regions. In fact, if you look at the domestic, intra-regional and money coming in globally, Australia has once again in 2012 overwhelmingly been the destination. Everybody talks about China. This looks at standing investment, so not buying sites, but even so, Australia has overwhelmingly been the target market for that global capital. We see, as we'll discuss, we see some competition coming back because we think that domestic investors here are starting to rebuild their activities. But we expect to see continued interest in this market. If you look at how overall volumes, this is not just cross-border, this is overall volumes in 2012 compared to 2011, you can see that those markets and sectors, actually you probably can't see unless you've got very good eyesight, but I'll tell you, the markets and sectors that we saw seeing the strongest increase, Australian office, retail and industrial are all up there in that top group. So strong demand from overseas, more demand coming through domestically. I think across Asia Pacific, the one challenge, the one issue that I'm concerned about is not finding the right stock. I think that is clearly a challenge. The thing I'm concerned about is pricing. If you look at the movements in prices in all three sectors, in terms of rents on the left-hand side and capital values on the right, you can see that even though rents have recovered and are showing some degree of stabilisation over the last 12 months, that's not really true of capital values. In fact, capital values have moved significantly ahead of what's been happening to rents. And this demonstrates a really strong degree of buyer interest and a strong degree of price insensitivity on the part of many of the buyers looking at the Asian market. If you read any of the headlines about what's happening in Hong Kong, you can see signs of that in the feeding frenzy for buying individual hotel rooms, strata title and car parks. The government's seen fit, in fact, has seen the need to regulate loan-to-value ratios on mortgage products being put out by the banks to help Hong Kong people buy parking spaces. This is not a healthy environment, and it does concern me a bit that in some of these markets we're seeing buyer pressure building up to the point that some pricing is becoming a bit unstable. But in general, I think that it remains the case that the Pacific region looks extremely good value. We're going to hear about what's going on down here in Australia. We're going to hear more about the Melbourne market. And I do understand that clearly there are issues and there are concerns about the economy, about the cost of debt and so on. From a regional and indeed from a global perspective, I have to say that most of the challenges that are faced by the Australian market are fewer and smaller, or at the least only the same, as those faced by pretty much every other market in the world. And if I'm going to take risk in making an investment, I would rather do it off a 7.5%, 8% plus initial yield than off a 3%, 3.5% initial yield, which is what you're paying in parts of Asia. So I think that pricing in particular, but also the quality of the markets, the liquidity, the availability of product, are significant attractions in the Australian market, which is why we've seen this flow of global capital that we've been expecting for a while start to come through. What do we expect to see over the next 12 to 18 months? Top investment picks. I don't particularly disagree with these. These are not our analytical top picks. This is really what we see in terms of the weight of demand coming through from investors, and I probably agree with most of it. Logistics definitely moving up the spectrum. We've seen strong interest in that here in Australia. We're seeing rising interest in it, particularly in Japan, in China, partly pricing, partly availability of some product, but that's certainly rising up the spectrum. Australia, definitely, as I say, high on people's agenda, and New Zealand, obviously not as big and as liquid, but it does offer many of the same attractions. Japan is high on people's agenda, largely Tokyo offices, but also logistics and others. Partly a spread play. Debt's very, very cheap, so even though yields are low, it's seen as a very attractive market, but also seen as something of a recovery play, and hopefully Abenomics is going to finally generate some growth there. And China, clearly still seen as the major long-term growth bet for the region. So, all in all, I think that whilst core product does look expensive, it looks expensive everywhere around the world, and there are still plenty of people who regard that as a good place to be, given some of the longer-term uncertainties around potential inflation and the outlook for the global economy. Hopefully, this time, we're right in saying that we are coming into a period where we will not see spectacular growth, but we will see a slow and steady sustainable recovery. And in that context, if we're right, as I say, I do expect to see a slightly sharper recovery in Asia Pacific than elsewhere in the world. With that, I hope that gives you a kind of very high-level view of what we're seeing and what we expect. So to start drilling down into what we see closer to home here in the Australian market and in Melbourne, I'll hand over to my colleague Stephen McNabb, our Head of Research for Australia.